We're always told that in uncertain times, cash is king. It's the safe move, right? But what if that's totally wrong? What if holding a big pile of cash is actually the single most dangerous thing you could do with your money? Today, we're going to dig into that.
So this whole thing kicked off with a question I got the other day. And honestly, it's a question I bet a lot of you have been thinking about too. Someone saw the headlines about Warren Buffett sitting on a record amount of cash and, they got a little nervous.
And that really gets to the core of the fear, doesn't it? You start wondering, wait, does the Oracle of Omaha see something we don't? Is there some huge crash coming, like another dot-com bubble that's just waiting to pop?
Okay, so let's tackle this head on. First up, let's deconstruct this whole panic around what Warren Buffett is doing. It is so easy to see a headline and get swept away, but the reality? It's usually a lot more nuanced than that.
So let's put this in perspective. Yeah, Buffett's holding about 30% in cash. You could call that relative caution. But here's what the headlines don't scream at you. The other 70% of his massive portfolio is still fully invested in the market. So seeing that 30% number and deciding to sell everything you own, that is a huge mistake. It's completely ignoring the bigger picture.
All right, so that brings us to the next big worry, the bubble. The second people hear tech and mania in the same sentence, their minds just flash back to the big dot-com crash in 2000. Is all this excitement around AI just the same thing happening all over again?
Well, the short answer is, probably not. I mean, yes, there is a ton of excitement around AI, for sure. But the sheer scale of the public frenzy and how disconnected valuations are from reality, it's just not comparable to the dot-com mania. Back then, you had companies with literally zero revenue going public for billions. It was a totally different beast.
And here's the really counterintuitive part. Even if a bubble is forming, sitting it out in cash means you miss the entire wild ride up. That explosive phase, right before a potential pop, is often where people make life-changing money. By staying on the sidelines, you guarantee you miss 100% of that upside.
And this brings us to what might be the actual greatest danger for an investor today. It's not about being in the market when it goes down, it's about not being in the market at all.
Okay, this is a super important distinction. Being underwater just means your good assets have lost some value on paper. It feels awful, I get it, but it's usually temporary. Being sidelined, on the other hand, that means you're out of the game. You've missed the rally completely, and that's a permanent loss of opportunity you can never get back.
And this right here just proves the point. I mean, think about some of the best assets of the last few decades. Apple, Amazon, Bitcoin. Every single one of them had absolutely terrifying drops. Some lost 80, even 95% of their value. But for the people who just held on, they didn't just get their money back, they saw 100-fold returns. Being underwater was a feeling, but the gains were monumental.
And all of this leads to this really powerful psychological trap. Because once you step off that train while it's moving, man, it is incredibly hard to talk yourself into jumping back on.
Let me tell you a quick story. A friend bought Bitcoin way back in the day for just a few $100s. I mean, what an amazing entry point, right?
Well, they sold it, made what felt like a ton of money at the time, and got off the train. Now today, with Bitcoin at $60,000, can they convince themselves to buy back in? No way. Psychologically, it's just about impossible. That gap between where they bought and where it is now is just too big to overcome in their head.
And that right there is the trap. Your brain gets stuck on that old, low price, and it makes today's price feel ridiculously expensive. That mental block stops you from ever getting back in the game, and you end up sidelined forever. The lesson here is simple. With a quality asset, you can't really exit unless you're prepared to never own it again.
Okay, so if sitting on the sidelines is the real danger, and our own brains make it tough to get back in, what do? How do we avoid the trap? Well, it might require a complete shift in how you think, moving away from building a static pile of cash and towards something way more dynamic.
And that alternative is cash flow investing. The whole focus here isn't on how much cash you have saved up. It's about how much income your assets are generating for you month after month. The idea is you can afford to have almost no cash in the bank if you have a strong, reliable stream of cash coming in.
The whole philosophy is actually really simple. It just comes down to two rules. Number one, you can't stop creating value yourself. Keep working, keep building. And number two, make sure your assets don't stop working for you, generating returns through things like dividends or yield.
So when you boil it all down, every single one of us is left with a very clear choice between two very different ways to handle our money and navigate the market.
Let's just break down these two paths. If you hold a massive amount of cash, your absolute best-case scenario is mediocre. You avoid a temporary dip, woohoo! But the downside? It could be disastrous. You mistime everything and you miss an entire era of growth. Now look at holding quality assets. The worst case, you might have to wait a few years for the market to recover. The best case, you get a great result, maybe even right away. The risk-reward is just massively skewed towards staying in the game.
So I'll just leave you with this final question to think about. When you really get down to it, what's actually more terrifying? Watching your portfolio take a temporary dip on paper, or being permanently left behind by an entire generation of wealth creation?
Smash like and subscribe.